Supermicro grew revenue 47% last year. Gross margin, 11%. Lower than Walmart. Lower than Costco. Demand record. Pricing per rack record. The AI server boom is the worst high-growth business in technology. The most in-demand product on earth has the worst margins on the market. Here's the part that doesn't add up. Every layer of the AI server stack is making record profit. Every layer except the one with AI server in its name. Let's start with the box. An AI server is not a server in the way you used to think about servers. A flagship Nvidia GB200NVL72 rack, the current state of the art, is 72 Blackwell GPUs, 36 Gray CPUs, all linked by NVLink switches, fed by a custom power shelf, cooled by direct liquid plumbing. Base configuration sells for about $3 million. Fully built out, closer to $3.9 million. A standard enterprise server, by comparison, costs a few $1,000s. A single AI rack costs 15 to 32 times more than the dual-socket server it replaces. By 2026, AI servers are 74% of the entire enterprise server market. Here's what should be a paradox. Demand has never been higher. Pricing per rack has never been higher. The margins of the companies actually building them are collapsing. Supermicro, ticker SMCI, the closest thing to an AI server pure play on the US exchanges, booked $22 billion in fiscal 2025 revenue, up 47%. Gross margin, 11.1%. Down from 13.8% in fiscal 2024 and 18% 2 years before. 1 quarter, gross margin dropped to 6.4%. Dell Technologies ISG segment did $19.6 billion in Q4 fiscal 2026, AI server revenue of $9 billion alone, up 342% year-over-year. Operating margin, down. Goldman Sachs initiated SMCI at sell. Why are the margins so bad? The GPU is the product. SemiAnalysis tore down an HGX H100 system. 8 Nvidia GPUs are 83% of the bill of materials. The OEM's metal, power, motherboard, cabling, everything outside the GPU, is 17%. The OEM is a markup on an Nvidia bill, and the markup is small. The customers have all the leverage. Hyperscalers buy in tens of thousands of units. Microsoft, Meta, Amazon, Alphabet, and Oracle are spending $700 to $725 billion on AI infrastructure in 2026 alone. They negotiate the way Walmart negotiates with a chicken farmer. And there's a cheaper alternative one container ship away. Hyperscalers can buy direct from Taiwan ODMs, Foxconn, Wiwynn, Quanta, and skip the US OEM markup entirely. They increasingly do. So who are the listed names? 3 US headquartered server OEMs, Supermicro, revenue $22 billion, gross margin 11%, AI servers more than 70% of the mix. Backlog around $13 billion. The whole story. Dell Technologies, ticker DELL, ISG, server and storage segment, hit $19.6 billion in Q4 fiscal 2026, up 73%. AI servers alone $9 billion that quarter, up 342%. AI backlog $43 billion. Dell's defense, scale and a real services business diluting the margin pain. Hewlett-Packard Enterprise, ticker HPE, $34.3 billion in fiscal 2025. The big move was buying Juniper Networks for $14 billion in July 2025. Networking is now the margin defense, with combined networking projected at over half of company operating income. The quieter, more important layer is in Taiwan. Foxconn, Hanhai, ticker HNHPF, did 8.1 trillion new Taiwan dollars in 2025, up 18%. In Q2 2025 their cloud and networking segment overtook consumer electronics for the first time. Management estimates Foxconn assembles roughly 40% of all AI servers globally. The Houston, Texas plant, focused on GB300NVL72 production for Nvidia Direct, started operations in Q1 2026. Wiwynn, ticker 6669 in Taipei, revenue grew 164% in 2025. Over half came from a single customer, Meta. Quanta, ticker 2382, did about 2.1 trillion NTD, up 51%. Inventec is leaning into custom ASIC systems for hyperscalers. GigaByte, ticker 2376, grew 27% with AI servers over 80% of its server segment. Now the punchline. If the OEMs are running 11% gross margins, and an AI server costs $3 million, where is the money? Nvidia, ticker NVDA. Last quarter, fiscal Q4 2026, Nvidia did $68.1 billion in revenue. Data center segment alone, $62.3 billion. Gross margin company-wide, 75%. Data center, 76.5%. Nvidia captures 83 cents of every dollar inside the box, then earns 3/4 of that as gross profit. Then the picks and shovels suppliers. Astra Labs, ticker ALAB, doing $852 million up 115%, sells the retimer chips inside every Nvidia rack. Marvell's data center segment hit a record $6.1 billion. Vertiv, ticker VRT, $10.2 billion revenue, 36% gross margin, doubled liquid cooling sales last year. Now the structural risk. Supermicro disclosed in its 10-K that 4 customers represented 55% of fiscal 2025 revenue. One single customer, labeled Customer G, was 31% of revenue in a single quarter. By Q2 fiscal 2026, one customer was 63%, about $8 billion from one buyer. Wiwynn, Meta is over 50%. Inventec, ASIC work concentrated in 2 hyperscalers. The entire AI server assembly stack is one phone call from a major customer pulling away. Microsoft pulling AI workloads or pausing. They did pause Wisconsin and Ohio buildouts in early 2026, though they framed it as power-bound, not demand-bound, sends ripples through the OEM tier instantly. There is one place inside the AI server economy where margin still lives, and the OEMs know it. Direct liquid cooling. About 38% of AI server racks are now liquid-cooled, up from 20% 2 years ago. By 2027, most Blackwell-class racks have to be. The thermal load left no choice. Vertiv runs 36% gross margins selling the cooling. Supermicro built an entire data center building block solutions push around bundling the rack plus cooling plus power. The pitch is simple: stop selling boxes, start selling rooms. That's where the margin is. Here's the landscape on one screen. 11 companies. What jumps out? Nvidia, 75% gross margin, sits at the top of the value chain. Vertiv at 36%. Then a long fall, Supermicro at 11%, Dell ISG margin compressing, HPE rescued by Juniper networking. Lenovo's ISG is currently running at an operating loss with a $15.5 billion AI pipeline. The Taiwan ODMs, Foxconn, Wiwynn, Quanta, Inventec, GigaByte, are running roughly 3% operating margins across the board. Winning unit share, not capturing dollars. Penguin Solutions, ticker PENG, the smaller US-listed AI infra pure play, just guided fiscal 2026 with zero hyperscaler hardware revenue. They walked away from the worst margin business in the industry. What happens next? Most likely path: AI server OEM gross margins compress further through 2026 before stabilizing in 2027 as liquid cooling and bundled rack solutions take more share. Probability that Supermicro returns to 13% gross margin by end of 2027, in my view, around 35%. Probability that one US OEM is acquired or exits the AI server business by end of 2027, also around 50%. Watch 3 signals. Supermicro quarterly gross margin. Above 12%, the bundling strategy is working. Below 9%, structural commodity trap. Dell's ISG operating margin. AI mix is now over 40% of segment revenue. Holds above 10%, AI is accretive. Below 7%, AI revenue is value destructive at current prices. Share of new hyperscaler deployments going to Taiwan ODMs versus US OEMs. Foxconn, Wiwynn and Quanta keep gaining share above the current 60 to 70% of large cluster builds, the listed OEMs lose pricing power faster. Catalysts up, Super Micro's $20 billion DataVolt Saudi deal converting to revenue. Catalysts down, the March 2026 DOJ indictment of 3 former Super Micro executives, overhang unresolved, and Foxconn's Houston plant ramping faster than expected. Upstream, Nvidia, custom ASICs, HBM, optical interconnects. Downstream, every hyperscaler, every neocloud, every enterprise GPU buyer. They sit downstream of these 11 companies. The most in-demand product on Earth. The worst margins on the market. The money is in the box, just not on the box. I'm Big Z, follow me, see you in the next deep dive.